Hi, it's Professor Mike. Chapter 24, completing the audit, finally. Um, this area is about presentation and disclosure. Hopefully, in the audit areas, you've gathered sufficient evidence about the balance sheet and P&L and cash flow statement. But this is about actual disclosures or other items that could affect the balances in the financial statements, either during your audit work or right up to the point where you issue your audit report. So this is also the evaluation of all the evidence you've gathered. So it's really about looking for things that aren't there as much as looking for things that are there. You want to make sure that transaction-related presentation is appropriate, like you know, disclosures of material transactions, um, and things like revenue recognition policies, things like that. And then balances. You want to be able to disclose components of inventory, components of fixed assets, the policies around those, etc. And then contingent liabilities, right? You want to understand whether there's a commitment to make a payment to a third party. Rent is one. The new lease accounting standard will deal with some elements of that, but you also have things like royalties, things like contractual commitments. There's a bunch of different things that can fall into this, and those all need to be disclosed. And then also, if you have potential liability from litigation, from claims, things like that, those need to be disclosed. Um, the accounting treatment goes all the way back to a statement called FAS 5, which basically says if it's reasonably estimable and probable of assertion, you should accrue. But you need to hit both of those standards in order to accrue. So you can't just accrue a potential tax audit liability without having some detail for it, because then that's just a general reserve that could be pulled down at any time. You can't establish a general litigation reserve, things like that. You have to be able to support the balances in those. But you also need to make sure that if those situations arise and they hit the standard, um, then they must be accrued. So the procedures are generally inquiries of management, um, you know, having qualified tax personnel review and review correspondence from both, federal and state agencies. You review correspondence from the SEC. You review the minutes of directors and shareholders meetings, although most of those are very vanilla and are cleansed by the lawyers, so they don't really tell you much. And the biggest one is really analyzing legal expense. So you look at all the lawyers that the company did business with either in the prior year or this year. If they terminated a lawyer, you still want to send a legal confirmation to them, because you want to make sure that if there's something that they know or they terminated with it as a result of a disagreement with the client over a pending litigation matter, you want to get that information because it may be important to the audit. You will send confirmations to the lawyers as a result of it. So, you'll get a letter from each major attorney. You don't have to do minor attorneys. And then you'll examine, you'll examine those and inquire the client as to the status, or maybe consult with the attorneys and things. Lawyers' letters are a difficult part and are usually done by, administratively, you might send them out, but the review of them is usually by senior members of the team to make sure that they're aware of anything that could be happening. And then you also look at letters of credit, right? Those are often available cash funds to the company, provided they are in compliance with all their debt covenants that we've talked about in prior chapters, but they are probably not drawn down. So they can show a zero balance on the financial statements. You won't pay any attention to them, but they do have the potential to draw them down, and you need to disclose that availability because it does, it impacts an investor's decision knowing that there is money available to the company if it hits a cash crunch. But also, you want the investors to know that the company could potentially borrow without investor approval because they've already got an established line. So that's, those are important things to do. This is a codification of the FAS 5 standard. If it's reasonably estimable and probable of assertion, you accrue it in the financials. If it's reasonably possible, you do footnote disclosure. Even if it can't be estimated, you still disclose it. And then if it's remote, no disclosure is necessary. And this is an example of a contingent liability footnote. Here we go deeper into the inquiry of attorneys. So, you're looking for pending and threatened litigation or any asserted or unasserted claims or assessments of which they've had involvement. So the company may be alerted by, a lawyer that their client is thinking of filing a claim, or they have potential claims resulting from something that they're aware of, like, let's say they're a semiconductor company and their manufacturing facility had an environmental waste leak, and so they haven't gotten any claims from the government, surrounding residents, etc. But they think that there's a possibility that they will. Then those would be what are considered unasserted claims. So the standard inquiry asks for the lawyer to furnish information and ask them to they'll verify existing cases, which will be outlined in the letter, and then also verify anything else. And then they also need to inform management, and then if the lawyer doesn't tell you something because they don't want to violate attorney-client privilege, it's up to management to disclose information to you. The confidentiality thing and protecting attorney-client privilege, this is where lawyers' ethical standards and the standards of the audit profession butt heads, right? There is an attorney-client privilege. There is not an auditor-client privilege. There is not an auditor attorney privilege, right? You have to have the client in the middle of these things, and sometimes the client is not incented to tell you everything that they know, and so it's up to you to get all this information and make sure that you thoroughly understand these cases. And again, this is generally more senior members of the audit team. And then you face a potential scope limitation if you can't get information about material litigation or claims. And Sarbanes-Oxley does put some requirements on attorneys for public companies to report material violations of securities laws, but that's restricted simply to securities laws. So let's talk about subsequent events, right? The audit report date is the date in which all material evidence has been gathered and completed. So that audit report date might be, in this case, 3/11/20 for a balance sheet date of 12/31/19. And the client may not issue their 10K until 3/26, right? So the auditor is responsible for reviewing information between the end of the financial statement date and the audit report date. you want to get the client issuance and the audit report date as close as possible, because that's still a kind of nebulous period, right? But up to the audit report date and you issue the financial statements, you have some responsibility, right? Um, you're reviewing subsequent events, and it's normally limited to the balance sheet date, but you will get sued if something happens after the report date and before the financial statements are issued. So that's why you want to keep those things as close as possible. Um, there are two types, type 1 and type 2, easy enough, right? Um, so those that have a direct effect on the financial statements require adjustment. That's more rare. But those that have no direct effect on the financial statements, but for which disclosure is required. Um, so you normally you look at subsequent events. You'll do a search for unrecorded liabilities up to the audit report date. You will do inquiries of management up to the audit report date. Your procedures are specifically designed to do this. Okay, um, and the the situation where the report is not issued until until significantly after the audit date is, we need to expand our tests, right? Um, the and if you find a subsequent event in that time, you need to evaluate that. And then finally, the auditing standards, require you to perform analytical procedures. That's very important, because you get so detailed and so in the weeds that it's just really important for you to step back and look at the numbers and ask if they make sense. Quite often, towards the end of my KPMG career, my job was to go in and review high-risk clients right before the audit work was completed. So I, as an independent senior manager at that time, would go in and review the work papers. And unfortunately, in a few cases, I found some very important misses that the audit team had missed, and they had to go back to the client and do a bunch of work or make adjustments. Those, having a fresh set of eyes on it in the form of a second partner review, but also in the form of an analytical review, is really, really valuable, and you can't underestimate that value. The partner is also um, able to step back because they're not in the day-to-day detail quite often. So they can look at things with their experience at reviewing financial statements, and also their experience with the client, and be able to kind of spot things that just looking at the financials that less experienced people, or people who have been too deep in the detail have don't always see, right? Um, so if you find stuff, then that may be just a requirement to do a little bit more audit work. It may not be an adjustment. It may just be, hey, we need a little bit more evidence about this particular issue. Um, you know, you'll other things you can do are run analytics to see if any unusual adjustments have been made, or anything that has been done subsequent to year end. Have they had significant cash payments out to people that like bonuses or things that should have been accrued, all those kinds of things. Okay. um, you've got to evaluate going concern. Way back in chapter 3, we talked about going concern, and that's one of the things you need to evaluate at the end of the audit, to see whether the company has sufficient funds to continue for a period of 12 months from the audit report date. Um, You obtain a management representation letter, uh, which contains not only standard representations about understanding what management's responsibility is for the financial statements, but also specific representations about account balances and things like that. And then in the case of public companies or companies that issue other information, I'm on the audit committee of a not-for-profit, and they put an MD&A section into their financial statements, even though they don't need to. They have supplementary disclosure information because um, they're a charter school, so they need to provide attendance information, things like that. Those go with the financial statements, and so the auditor is required to read those as well. So the supplementary information that can be in the basic financial statements could be statistical data, could be other comparative. The non-GAAP information is a big one. Uh, Things like that. There are good checklists available to you, when you're a member of a firm that will, help you with making sure that these procedures are followed. And then ultimately, this is all about evaluating results. And ultimately, the person who evaluates the results is the partner with assistance from the second review partner. But that's the person who needs to evaluate whether they got all the information, because that their career is on the line if something goes wrong potentially. You saw that with the audit partner at Enron, right? And a lot of audit partners, lose their jobs over shoddy audit work because the other partners don't want to expose the firm to someone who has a history of shoddy audit work. It's just not worth it. So, um, it's very serious in each audit. Um, you know, um, and it's basically, do you have evidence to support the opinion? Are the financial statement disclosures appropriate? Is the audit documentation complying with auditing standards? And is it clear and concise? That you can't, um, you can't understate that either, because you could have PCAOB reviews, you could have internal quality control reviews, you could have your quality control from another auditor, and you could have either governmental tax or litigation that would uncover the work papers. And so it's not only the fact that you gathered the evidence, but how you documented the evidence that's critical. The engagement quality review is, a lot of times that second partner review, um, and summarizing, having a memo or some other form of documentation that says the partner is comfortable with the evidence and has reviewed stuff. And again, all this stuff is going to be electronic now. So, Brian signing off on work papers for Ernst and Young is all electronic at this point. Many companies, and in fact, you can even look on the on different websites. They have financial disclosure checklists, which go step by step through each financial statement line item and have specific industry checklists. So there are lots of tools available to make sure you don't miss something. It's not like you've got to, know the audit standards and the accounting standards perfectly every time, although that helps. Checklists are great reminders. And then, you issue the audit report. If you've evaluated all the results and the partner is comfortable, then the audit report is issued. But you should wait to issue it until the partner is completely comfortable. And like I said, there's audit manuals and reporting manuals available, um, to identify what the type of report should be. And then finally, there's required communications with the audit committee and management. Those could be the management letter, like Vivian referred to, for restoration hardware. Obviously, internal control deficiencies are required to be communicated. If you detected either illegal acts or fraud, you must communicate it to the audit committee or management. And usually you'll have a private session with the management, with the audit committee, so the audit committee can ask you assessments of key personnel, whether there were any challenges in conducting the audit, anything like that. There are very specific required communications, including the internal control deficiencies. These are outlined on these and following slides. Management letter is encouraged but not required, and I think in a lot of cases, not sure how much you'll see those now, because it's as long as the audit committee understands areas where they have to focus, issuing a management letter telling them that is just added cost for the company, because they're paying for it. So they want to make sure they want to make sure that they've got what they need. And then if you find the audit report has been issued, you have an obligation to make sure, if it's material, that users of the financial statement know whether they can still rely on your report. If the client has been misleading, or the financial statements are misleading based on the subsequent facts, the appropriate thing is for the client to revise the financial statements and reissue them, and for them to issue a statement that you shouldn't rely on the financial statement. And then if they refuse, they need to notify the board of directors, withdraw their opinion, notify the board of directors, notify anybody who relies on the financial statements. This is a diagram of those kinds of things. Okay, so that's audits. We'll talk in the last chapter about other services.